Today, we're going to be talking about 5 common accounting mistakes business owners make, and one bonus tip at the end that could save you a lot of stress and money down the line. So, whether you're freelancing, running a startup, or growing a small business, these are essentially practical, real world mistakes you'll want to avoid, especially if you want to stay on top of your finances and out of trouble with tax authorities. So, let's get into it. Number one, mixing personal and business finances. One of the most frequent mistakes that business owners make. And it's especially common among sole traders and new entrepreneurs. So you start using your personal bank card for business supplies, or you dip into your business account to pay for lunch. It seems harmless at first. However, over time, this blurs the line between your business and personal finances, and that can create major problems. It can make tax preparation a nightmare because you can't easily tell what's deductible. You might even miss out on genuine business expenses you forgot about, or you can risk incorrectly claiming personal costs, which could be flagged if your tax return is reviewed or audited. So, if your business grows or you ever want to apply for a loan or bring on investors, this kind of looks like there's a lack of separation and it makes it unprofessional and unstructured. What you can do instead, though, is essentially one of the following. You can set up a separate bank account exclusively for your business, even if you're a sole trader or freelancer. In many countries, this isn't a legal requirement, but it's strongly recommended, I would say. Use tools like accounting software such as QuickBooks, Xero, Wave, or Zoho Books, and these can essentially record and categorize your transactions. Consider using a business credit card for easier expense tracking. If you accidentally use the wrong card, though, you can transfer the funds between accounts and log it quite clearly. So the bottom line is treat your business like a separate entity from day one. Number two, ignoring cash flow. Cash flow is kind of what keeps your business running day to day. But many business owners focus only on profit and sales and ignore timing. Timing is quite crucial, and that's a problem if you ignore it. So you might, for example, issue an invoice for $10,000 and feel great. But if the client doesn't pay for 60 days and you've got rent, payroll, and other bills due, then you're in trouble essentially. It's one of the main reasons why profitable businesses can still go under. As they say, cash is king. They run out of liquid cash to meet their obligations. There's lots of things that can disrupt cash flow, and that includes things like late customer payments, any seasonal drops in income, large upfront expenses, not tracking your recurring payments, subscriptions, tools, etc. So, a few ways to manage your cash flow. I would recommend essentially using a rolling monthly cash flow forecast. It doesn't have to be complicated, even a simple Excel spreadsheet will do. You should list your expected income and outgoings week by week or month by month, and then build in a buffer or reserve fund where possible. 1 to 3 months of expenses is a good target to aim for at the start. If you take deposits or upfront payments, you should include those in your planning also when you're forecasting. You can also explore business lines of credit or overdrafts as a backup, but only use them wisely. Good cash flow doesn't mean you always have to have a huge surplus. It should just mean that you're prepared and in control of your timing. The third thing is missing tax deadlines. So no one likes dealing with taxes, but missing deadlines can get really expensive, and it also shows poor financial management. Across countries, governments impose automatic fines, interest, and in some cases, compliance checks if you file or pay late. So in the UK, for example, missing the self assessment deadline by one day gets you a £100 fine. In the US, the IRS charges both a failure to file and a failure to pay penalty. So some of the common filing and payment obligations include your annual income tax returns. So it's your UK self-assessment or Form 1040 or 1120 in the US, your sales tax or VAT returns, which are normally often quarterly, your corporate tax filings. The deadlines for this would vary based on your business structure, and payroll returns, such as PAYE in the UK or IRS Form 941 in the US. Some ways to avoid these issues would be to set calendar reminders for all your deadlines, not just the filing date, but also when you need to gather documents. You should try to schedule time in advance to prepare. Don't leave it until the last week. Use tax software that alerts you to upcoming deadlines or changes. Make the most of the technology. Consider working with a tax advisor who can track it all for you, especially if you're in multiple countries or have complex affairs. If you think you can't pay your tax bill in full, it's probably recommended to contact your tax authority early. Most tax authorities offer installment plans or payment arrangements, but they're much more flexible if you're proactive. Number four, poor invoicing and credit control. If you don't invoice promptly and chase unpaid invoices, you're essentially going to be giving your clients an interest-free loan, and that's going to hurt your cash flow. I've seen businesses deliver the work, then wait days or even weeks to issue the invoice. And then if the client delays payment, you're stuck and often too uncomfortable to chase. Late payments is something that's a global issue, especially for freelancers and service-based businesses. And in order to stay on top of it, you should try to create a system where invoices go out immediately after the work is delivered. Don't delay. Set clear terms up front. So, for example, payment due within 7 or 14 days is better than the default 30 days. Use invoicing tools like FreshBooks, QuickBooks, Zero, Wave, or Zoho Invoice in order to automate your reminders. Consider any automated payment options, Stripe, PayPal, or Go Cardless for recurring clients. Follow up on unpaid invoices regularly. So the day after due date, set a friendly reminder. 1 week later, maybe send a firmer email or call. 2 weeks later, you can maybe escalate it or send a small claims warning. For high value clients, a contract with late payment fees or interest can also encourage timely payment. And then the fifth and final one is not reconciling accounts regularly. So reconciling means checking that your bank transactions match your records, and it's vital to keep your books accurate. If you wait until the year end to look at your finances, you'll forget what the transactions were for, and mistakes are probably more likely. So some common issues when businesses don't reconcile regularly is that missed income that never gets recorded. They may have some duplicated expenses. You might even categorize transactions incorrectly, or there could be discrepancies between the bank balance and accounting reports. So, some best practices would be to reconcile your bank and credit card accounts weekly or at least once a month. Use cloud accounting software to pull in the transactions automatically. That would save you time, and then all you'd have to do is just match them with your invoices and expenses. Attach receipts and notes while the transaction is fresh in your mind. If something looks off, like a payment you don't recognize, investigate it early, not 11 months later. Keeping clean records also makes it easier to file your taxes, apply for any funding, or respond to any audit or review. A bonus tip, I would say, is to get professional help early. The earlier you get professional advice, the fewer headaches you'll have later. Many people think they can't afford an accountant at the beginning, but even a 1 hour consultation can make a massive difference. So, this could help with choosing the right business structure, an LLC versus sole proprietor, a limited company versus a partnership. Being able to understand what taxes you're liable for from the start gives you a clearer indication. Setting up software the right way from the start can also help with automating and avoiding any common compliance or registration errors. It's much cheaper to get it right early on than to clean up a mess later. Also, an accountant can be more than a compliance person. They can help you spot tax saving opportunities, make better pricing or investment decisions, and understand your numbers in a way that drives growth. So, as a recap, the five most common accounting mistakes to avoid would be mixing personal and business finances, ignoring cash flow, missing tax deadlines, poor invoicing and credit control, and not reconciling regularly. And also, the bonus tip to get professional advice early on. It's one of the best investments you can make in your business. If this video helped you, hit like, subscribe, and share it with someone else running a business.